Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Okay, and the questions I like to ask myself when managing my Vega risk is, what's my overall volatility exposure? Am I bullish or bearish, neutral on price and volatility? Sometimes those two are the same thing in terms of like if I'm bearish on price, I'm bullish on volatility. Other times if I'm bullish on price, I'm maybe bearish on volatility, or other times that may not be the case. So these are all questions I like to ask myself amongst many other questions before I put on a position. Also ask myself, how well do I think I can trade this spread? Well, if I'm looking to be long volatility, all right, my style as a trader is to never be like purely exposed to one thing or another, okay? My style as a trader is to, okay, I take on an exposure here, but I like to take profits at logical points. Or I like to, to manage the risk. If I get in a position, I try and pick good spots to get in. If they're bidding the market up, I want to go bid and work the order flow on the buy side. If they're selling the market, I want to work the order flow on the sell side. Tends to keep me fluid, tends to keep me from getting in too much, in too much trouble. So I kind of try and take the same way as well. If volatility is going up, I tend to try and be long volatility and work the flow of the market because there's a rhythm behind it. Last fall it was not a time to be selling, and again, it's easy to say that now. I mean, I guess it's all your time frame behind it, but last fall is probably not a time to be selling short-dated at-the-money calls or puts. The ranges we got and some of the stories I heard of what people lost trying to perform those strategies is pretty eye-opening. But at the same time, if there's a rhythm to this market, then I want to be involved in that market, and using ICE-FX options is one way to take on that exposure. And then talk about, is the market in a rhythm? Again, that's something that I like to do sort of as an internal check to see how I want to take on exposure there. Right now, I think the markets have not been so rhythmic and have not been so fluid. That's part of that. There's some seasonality there. We got a pretty robust move. We saw the euro come off the 123, 124 level, post up near 142. I mean, there's a nice move there. But the last couple of months has been, especially with the S&P, has been more of a grind, and we've seen the average true ranges come in. And, we've had some blips and pops here and there, so it's not to say that there isn't some increase in volatility from time to time. But in terms of where we were 3 months ago or 4 months ago, we've definitely come off the peak. All right, a little bit about just what I have coming up here and what I do before I go into the live trading stuff. Talked about I'll be speaking at the Las Vegas Traders Expo in November. Not sure what I'll be doing there just yet, but I'm sure it'll be something fun. My book, One Shot, One Kill Trading, goes over a lot of the specific trading methods I have. And I'm really big on helping emerging managers and CTAs, hedge funds, whatnot. I speak with them, whether from a strategic standpoint or structural standpoint. I'm a member of a different regulatory or one regulatory body, so I've definitely been through the ringer. I've gone through the process of managing money professionally, and I've been through the good and the bad of that. And so, I promised myself that I would help other traders out there and help other people that are looking to take the next step professionally, and I can at least share my insight with you guys in terms of what I've done and what I've seen work for me, and what you may want to do as well for you going forward. Sniper Squawk, I'm really excited about this coming out. Going to be an audio room that has myself and a number of other traders out there that share real-time information on the currencies. Because there's a lot of good squawk rooms out there that they do a great job of covering the news, but in terms of like getting actual plays from those squawk rooms, that's not necessarily their perspective or their edge, which is fine. It's your job to extrapolate that information and go from there. And so I want to assemble a room of just great. I'm assembling a room of great traders who have committed to coming on board. It should be really exciting, and I'm looking tremendously forward to that. So more information on that. The trial, that'll be $25 and so on and so forth. So now I'm going to go to share the desktop mode, and I'm going to bust out my where I see these currency markets going and what we really want to do to make this happen. All right, this is a bit of what we've seen. This is the crude market here, which again, everything kind of became one trader. We actually see a chart of crude, and the average true range of crude actually increased since the middle part of June as we've as we've sold off here in that precipitous sell. That's not really the thrust of what I'm going to focus on today. But let's take a look here at the euro and what this means on a daily chart and sort of what's happened here in the past. So people have talked about, we'll take a look here of this average true range of the euro. We've seen here up near close to 320 ticks a day, and again, this average true range is based on, just to give you guys a sense here of how I have this priced, on 20 periods of the last 20 periods in the sense of what that range has been. Also, I do that because I look at historical volatility or realized volatility on the same time frame as well, kind of keep a perspective on that, and you can see that through this consolidation, we talked about this big move. We talked about the euro being down to the 125 level. Last fall, we saw this back to the 123 level, but obviously nice rally up, higher low, one by one, ABC. We put in a nice 5-week move higher, and then we hit into consolidation. With that consolidation, has seen implied volatility fall off, at least the implied vols of those options. And we've also seen the average true range decline as well in the currency space. So for me, as I see a range like this, I have a couple of approaches. If you're not an options guy, my first thing is to really exercise patience or to compress your time frame. And i.e., like this is a daily chart right here, so maybe go down to like a 60-minute and see if there's some opportunity embedded in there. And as I suspected, it's very difficult, even within that time frame, to make that happen. So as we look at spots here, this is a chance to either put on maybe a condor spread or even butterfly this thing out, depending on which direction, how long you think this is going to hold on to. Right now, you can work some strategies where you can sell you could put on a bear call spread up to the 142 level, sell the 140s, buy the 142 halves, take on some exposure that way. You can also work the lower side as well, and there's a couple of benefits that can come from putting on this bear call spread or bull put spread or iron condor, however you want to deem it, depending ultimately where you pen the strikes at. And that is, if you are a trend trader, okay, having a range trading component to your strategy, i.e., putting on a bear call spread while putting on a bull put spread. If the market does break up and you can play that move higher, you may end up losing money from that iron condor you put out there, but the hope being that you can more than make that back from playing the move higher and rallying it from there. Conversely, if you find yourself getting chopped out, while you're getting chopped out, those iron condors are picking up value on them while the market continues to meander and go in that direction. Again, these are just some ways to play this move. Now, when I look at this 137 half level, this is a really key pivot point here. And so if I wanted to play a down move here, let's just say you're a bearish to the market, which I'm not particularly bearish or bullish to the euro right now, but looking at this 137 half level right here, this is a key inflection point. We've seen this move bounce off here, and I'm highly circumspect in the fact that the first time we come back to this level again, we're going to bounce off that spot. So for me, even a bull put spread, the 137 half, 135 is an acceptable way to put on a bullish market viewpoint, or conversely, if you're bearish this market, like I talked about, maybe selling the 140s and buying the 142 halves up in here. And in terms of the EUI, which is the ICEFX option for this market, it would be the inverse of that. So maybe you would sell the 70s and buy the 69 halves, sell the 70s and buy the 69 halves, or you would sell the 72s and calls and buy the 74 calls to put on a similar market viewpoint.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.